Welcome to Introduction to Accounting Preparing for a User's Perspective, Defined Common Liability Accounts. How are liabilities defined by the FASB? Liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. An example of a liability would be an account payable. For example, if you buy inventory from a company and promise to pay later, the past transaction is you bought inventory, and you are obligated to sacrifice in the future some assets because of that obligation. You are currently obligated to make that sacrifice in the future. Let's look at some common liability accounts and see how they meet this definition. These are the common liability accounts that we will discuss as we work through this topic. As you will notice, many of these have the word payable on them, indicating that an amount needs to be paid in the future. But not all liabilities use the word payable, as can be seen here on unearned sales revenue. You should already be familiar with the T account format that we introduced when we talked about assets. As you can see, liabilities and equity are on the right-hand side of the balance sheet equation. Therefore, liabilities will normally have a balance on the right-hand side. We'll start with the beginning balance on the right. All increases will be recorded on the right and decreases recorded on the left, which is exactly opposite of what we do with assets. Why is it opposite? It's because they're on the opposite side of the equation, and you should normally wind up with an ending balance on the right-hand side. Accounts payable. We just gave an example of buying inventory on account. Accounts payable increase when you purchase from suppliers on account, or we sometimes call that on credit. They, the accounts payable, decrease when you make payments to the suppliers. Therefore, we no longer owe the money. Sometimes suppliers will give you a discount on the amount that you owe if you pay early. For example, if you pay within 10 days, the suppliers will give you a discount. Discounts can reduce the amount of accounts payable that you owe. Also, if you return previously purchased on-account items, your accounts payable will decrease. Company A began the day owing $3. That's our beginning point. Today it purchased $5 on account, asking to pay later, thus increasing the account payable. Tomorrow, it will pay off $7 of what it owed, thus reducing the account payable. What is Company A's ending accounts payable balance? We started with $3 of accounts payable, added $5 by buying on account. That puts us up to $8. We then deducted the $7, ending with $1 still owing our vendors or our suppliers. Salaries and wages payable. Salaries are contractual amounts for employees based on an annual contract for work to be performed. They usually are paid monthly or bi-monthly, but the salary is based on an annual contract. Wages are amounts that are paid based on an hourly rate to hourly employees. Salaries and wages payable represent amounts owed to salary and hourly employees who performed work for the company, but they haven't been paid for it yet. Salaries and wages payable will decrease when payments are made to the salary and hourly employees. If the amounts owed are paid off, that would decrease this payable. Companies also withhold taxes and insurance from the amounts owed to employees, which amounts will then be sent on to the government and to the respective insurance companies. Company A began the month owing its employees $8,000, so that's our beginning balance here on the right-hand side. Employees worked for 2 weeks and earned another $7,000. When the employer does pay the $8,000, that will decrease the salaries and wages payable account. We started with $8,000, added $7,000, got up to $15,000 in salaries and wages payable, paid $8,000. They now owe only $7,000 in salaries and wages payable. Income taxes payable represent amounts owed to various governmental entities based on the company's income. It increases when the company earns income and estimates the taxes it will have to pay on it. It decreases when the company makes the required tax payments. Company A began the month owing $10,000 in taxes to the government. During the month, it sent $7,000 to the government of the amounts it owed, thus decreasing the income taxes payable. So we're down to $3,000 now. This month, it earned additional income resulting in $2,000 of estimated taxes. We were down to $3,000, but we increased it by another $2,000. That puts us up to $5,000 in income taxes payable. Dividends payable. These represent amounts owed to investors for the dividends that have been declared. It increases when the company declares a dividend. It decreases when the dividends are paid. Company A owed $13,000 in dividends it declared last year but hasn't paid yet. So that would be the beginning balance on the right-hand side here. During the year, it declared another $4,000 in dividends. So the investor will be expecting to receive these in the future. So now we are up to $17,000 in dividends payable to the investors. If the company cuts a check for all $17,000, dividends payable will decrease. thus resulting in an ending balance of 0. Interest payable. Interest payable represents amounts owed to lenders for interest on amounts borrowed that has not been paid yet. Interest payable increases when interest is accrued. That means it's been computed and recorded. It decreases when the interest is paid. Company A began this year owing $400 in interest from prior loans, so that's our beginning balance here on the right-hand side. On January 1st of this year, it entered a new $10,000 5-year loan with 12% interest due January 1st of each year. On January 2nd, it paid the $400 of interest it owed, thus reducing interest payable. As of December 31st, so this is now a year later, it computed that it owed $1,200 in interest on the new loan. Take the $10,000 amount they owed times the 12% annual interest rate and the time period of 1 year, and therefore they owe another $1,200 in interest. Since they haven't paid yet, this would be interest payable of $1,200. Unearned sales revenue. By seeing the word unearned, that means that they've received a customer payment, but because they haven't provided a good or service yet, they can't call it sales revenue and put it on the income statement. They must first classify it as a liability until they deliver the good or service as promised. This liability account under sales revenue increases when companies receive prepayments for future goods and services. When customers pay you now expecting to receive goods and services later, you as the company have future obligations. Unearned sales revenue decrease when companies deliver the promised goods and services, or if the customers cancel their orders and receive a refund. Assume the supplier began the month owing $5 in ice cream to customers who prepaid for it. Then, during the month, customers prepaid for another $100 in ice cream that they expect to receive later. Also, during the same month, after customers made the prepayments, they went in and collected $80 worth of ice cream. How much does the supplier still owe these customers? $105 is what was owed at a point in time because they started with $5 and then had another $100 of prepayment. Then $80 worth of goods or services were delivered to the customers, resulting in $25 of remaining unearned sales revenue. The $80 here is now earned revenue, so it comes out of the liability account and goes on the income statement as sales revenue. Utilities payable. These represent utility services received that haven't been paid for yet. They reduce when you actually pay for those services. Company A began the month owing $900 to the electric company. It then received a $300 bill for last month's water services. So they received the services, used the water, and they have not paid for it yet, thus increasing their utilities payable, which represents a liability owing to the water company. Company A then made a $500 payment for its electric bill that it owed at the beginning of the month, thus reducing its utilities payable. How much does Company A now owe for utilities, water, electric, and any other utilities? Well, you take the $900 beginning balance plus $300 for the bills received for prior utility services. That's $1,200, less $500 payments for utility services. It still owes $700 in utilities payable. Notes payable represent amounts owed under note agreement. Notes payable increase when amounts have been borrowed and a promise to repay has been given. Notes payable decrease when the principal portion of the notes are paid off. Company A began the year owing $4,000 as its beginning balance. This amount is due January 3rd. On January 1st of this year, it entered a new 5-year loan for $10,000 at an annual rate of 12%, and it's due January 1st, X6, 5 years from now. That's when the principal portion of the $10,000 will be repaid. On January 3rd, it paid off the $4,000 note as well as $1,000 of principal on the new note. The $1,000 payment was a little premature, and hopefully there is no prepayment penalty for paying that off early. The interest payable related to both these principal repayment amounts would also have to be paid, but that's not shown in this example. By doing so, at the end of the year, it would owe $9,000, which is $14,000, the beginning $4,000, plus $10,000 in new borrowings, minus $5,000 in principal payments, gives you $9,000. Mortgage payable. This one is pretty common in that many of you have heard of mortgages before. A mortgage payable increases when you borrow under a mortgage agreement. A mortgage payable represents an amount a company owes in relation to a loan it has received on something of value, such as a home or a building, or something else that has significant value being used as collateral. When you borrow a principal amount of money and provide something of value as collateral in case of non-payment, that will be called a mortgage. If you don't pay, they can foreclose on these items, sell them, and they can hopefully recover the amounts lent to you. Mortgages payable decrease when you actually pay off the mortgage principal. In this case, a company purchased a $500,000 building by paying down $100,000 in cash and borrowing the remaining $400,000 on a fully amortizing mortgage. Fully amortizing, meaning a portion of the principal gets paid off with each payment that's made over that time frame, at which point it is fully amortized, meaning it's paid off. And the monthly payment will be $1,909.66, due at the first of every month. On February 1st, X2, this is 1 month after the loan was issued, Company A made its first mortgage payment of $1,909.66. Of which $1,333.33 was just for interest. That means only the excess portion paid will go toward reducing the mortgage principal. This $1,333.33 will certainly reduce the interest payable, but it does not reduce the mortgage payable. Only the excess amount after the interest has been paid will reduce the mortgage payable. So how much is still owed immediately after the February 1st payment? $399,423.67. In the early years of a loan, most of the payment goes towards interest. Bonds payable. Bonds payable are simply another means of borrowing money from others. Usually this will be borrowed from debt investors or other companies. Bonds payable increase when bonds are issued, and they decrease when they pay off the bonds upon maturity. Or, if they are allowed to call the bonds, which means pay them off early, the bonds payable will decrease at that point in time. In this example, we started the period with $10,000 in bonds payable. Then let's assume during the period that the company issued 20 $1,000 bonds. That would be 20 times $1,000, assuming they issue at their face value. That would increase bonds payable by $20,000. As you can see here, this is a 20-year bond, so the due date when it matures is specified on the bond itself. The interest rate is 3.5% per year, so that will be 3.5% times $1,000 every year that will have to be paid in interest. On 20 bonds, that will be a total of $700 per year. If investors were to purchase these for $20,000, bonds payable would increase by $20,000, and the company's assets would increase by an equal $20,000. If Standard Electric chooses to pay off some bonds, it will decrease its bonds payable, resulting in an ending balance of $23,000. We have just completed a whirlwind tour of some common liability accounts. Liabilities are amounts that a company will have to pay or services they will have to render in the future as a result of some past transactions or events that obligated them to make those payments.